I think it's about time we had the talk. But before we start, Alan and I just want to make sure that you know that we love you very much. And although it may be awkward, just know you can always come to us with any questions you may have. Okay? Good. Now, as much as we may wish otherwise, we're pretty sure you've been exposed to this for a little while now. Kids have probably spoken about it at school. You've probably seen references to it on the TV and on social media. And so it's completely natural for you to be curious. You may even be excited by the idea. I mean, they make it out to be this amazing thing that could change your life forever. We just think that the downsides are often overlooked when it comes to this. And we would just prefer that you learn it from us, the people who love you. That way we can warn you of any of the dangers to make sure that when the time does come, you don't regret it. You may have noticed I've been avoiding saying what it is, but it's probably healthy to call it by name. So let's call it what it is. We're talking about contracts for difference, or as the kids are calling it these days, CFDs. Now, for those of you who could actually sit through that intro, thank you. But you may be thinking, danger? What danger? Well, I'm talking about the statistics that show that between 74 and 89% of retail investor accounts lose money when trading CFDs, forex, and spread betting. That's up to 89%. Could that actually be true? Many providers display this same warning, letting their customers know that there's a high statistical probability that they're going to lose money by using them. Now, of course, having these warnings on your website isn't the most comforting thing for a new customer. And it's likely that the only reason these warnings are there in the first place is because of some sort of regulation within the industry. But it does beg the question, why do so many people lose money? Are these platforms a scam? Is the game rigged against retail investors? Or are we doing this to ourselves? Are there ways to mitigate these risks and increase the likelihood of coming out in the green? Well, in this video, I'm going to answer those questions specifically. I'll hopefully be able to shed some light on why so many people lose money on platforms like eToro, and I'll be providing a few steps which, if followed, should put you on the right track to outperform the majority of investors. But quickly before I do, if you guys value the information and the free content that Alan and I provide here, we would really appreciate just a gentle tapping of the like button. It won't cost you anything and shouldn't take more than a second, but that simple act really does help us out in pushing our content to larger audiences and ultimately helps the channel grow. Now that that's out of the way, let's get back to that horrible statistic. Is this a recent thing? Is the number coming down? Are we starting to move in the right direction? Not exactly. Since the 1990s, when CFDs were first invented, pretty much all we've seen is a steady increase in the amount of people getting screwed by these investments. But interestingly enough, the reason for this increase isn't as sinister as you may think. To begin, one of the primary objectives of trading platforms in recent times has been to make investing more accessible to the everyday investor. Over the years, these platforms have broken down the barriers to entry, and now you can start trading with very little money in a matter of minutes. And initially, this seemed like a great thing. There has never been a time in history where it's been this easy to start trading assets and derivatives. And as a result, making money through these investments is no longer something that's reserved for the wealthy. However, as it turns out, these steps in the right direction also have some pretty serious negative consequences. Now that almost anyone can invest in almost anything, we have waves of people entering the market with little to no investing knowledge. And ultimately what's happening is people are gambling their money away on super risky investments and ending up worse than when they started. And so now it's become a balancing act. On the one hand, trading platforms are trying to innovate, trying to make investing more accessible, and trying to deliver newer, better investment options. While at the same time, on the other hand, they're trying to limit the number of investors making silly decisions and losing money. And as it turns out, trying to balance these two is no easy feat. So in the meantime, The only way we as investors can move forward is to try and understand what's going wrong for so many people and try our best to avoid that by taking responsibility of our own actions. So firstly, as investors, and this is particularly relevant to new investors, we need to be extremely cautious of our emotions and how they influence our investment decisions. Being especially cautious of hope, fear, regret, and most importantly, greed. Now, I've said this many times on the channel, and it actually comes from one of the oldest finance YouTubers around, and that's Dave Ramsey. But when all is said and done, the likelihood of you succeeding with personal finance, investing, money management, whatever you want to call it, comes down to only about 20% head knowledge, and the other 80% comes down to your behavior. It happens all the time in the investing world. You could have the mathematics completely right and have developed a sophisticated and well thought out investment strategy, but if you cannot master your behavior, you're not going to succeed with money. Now, if we think about the emotion of greed for a moment, imagine a new investor starting with only $500. It's very easy to see the comparatively impressive return of 20% over a year and think, well, if I'm only going to make 20% of $500, that's only going to be $100 over the entire year. Is that even worth my time? And when this is coupled with gurus all over the internet claiming that with little time and little effort, you could become a multi-millionaire by just joining a Facebook group and attending a few seminars with the potential outcome of making lots of money really quickly. But this is the exact wrong way to go about it, and is the reason we have so many people losing money. But believe it or not, it gets worse. The main reason CFDs are so risky and result in so many people losing money is because of leverage. Now, in the next few weeks, Alan and I will be doing an in-depth video breaking down leverage in more detail to explain why it is so appealing and dangerous at the same time. But to quickly summarize it here, the basic idea of leverage is allowing investors to invest with more money than they actually have. And this is done by borrowing money from the trading platform themselves. Let's say you have $1,000 to invest with. You could opt to do 2 times leverage, which would mean that you could then make a trade worth up to $2,000. And say you were to make a 10% return. If you were to just use your $1,000 in cash that you had, that would be a $100 return. But if you use leverage, 2 times leverage, then you'll make double that return, being $200, with only having put up $1,000 initially. But it doesn't stop at 2 times leverage. Some platforms offer 20 times leverage and more. Now, just from saying that, some of you probably have your stomach in your throat, while others are seeing dollar signs. And the latter is unfortunately where a lot of people lose money. Because while leverage does magnify your gains, it also magnifies your losses. And it's very easy to lose more money than the actual amount that you put into that investment to begin with. But many new investors don't see it like that. And all they see is the amount of extra money they can make, and they get greedy. They make extremely risky trades shooting for the stars, but just end up shooting themselves in the foot. And unfortunately, it only takes a couple of these bad leverage trades for you to wipe out your entire account. Now, does this mean that CFDs and trading platforms should be avoided at all costs? Not at all. But there are a few rules which I personally follow. Number 1, I don't do leverage trades for anything. Never have and likely never will. Now, while I do have a very strong opinion on this currently, I cannot guarantee this will be the case forever. And here on this channel, I always want to make sure I'm being as honest as possible. Perhaps one day there may be an offer that somehow, somewhere means that a little bit of leverage may be something that I think about. But it'll certainly not be until I'm much more knowledgeable in investing in general, not until I'm comfortable to lose the entire amount, including the leveraged money, and not until you smash the like button for the YouTube algorithm. The second rule is I always pay close attention to the fees. For those of you who have been following the channel for a while now, firstly, thank you. But secondly, you'll know I love diving into the details, specifically when it comes to fees. And other than the fact that I'm a little bit of a nerd, this is mainly for the reason that in most cases, minimizing your fees will result in more money at the end of the day than trying to expand your returns. Now, with regards to the types of fees you should look out for, disregarding any of the fees associated with leverage, because you guys are obviously all going to follow my first rule, things like trade commission, management fees, inactivity fees, deposit and withdrawal fees, spreads and FX fees are some of the most common fees charged to traders. To the final tip, which is I constantly remind myself of the dangers of trying to get rich quick. Time and time again, people from all different walks of life, if they try to get rich quick, they're most likely going to end up just getting burnt. And at the end of the day, acknowledging that this is the way it is, and instead developing a plan that will keep your emotions completely out of the equation is your best bet at making money when investing. If you take to heart all of the things we mentioned in this video and go ahead and use one of these platforms, I'm pretty confident you're not going to be just another statistic. But that's pretty much it for this video. I really hope you enjoyed and found some value in this video. If you had any other questions or any concerns, pop them in the comment section below. Alan and I get to every single comment, so we'll be sure to reply. Other than that, if you wanted to see more of this, make sure that you go down, click the subscribe button and that notification bell. That'll ensure that you're first to know when any new content is posted. If you can't wait until then, here's a video that YouTube thinks you'll enjoy, and this is our latest video. Hopefully one of those appeal to you, but if not, we'll see you in the next one.